Hello everyone. Thank you for joining Emagia's 9th Masterclass. Today's Masterclass topic is Strategic AR Management. But before we start, I request you all to please be on mute during the session. Any questions that you may have, please post them in the chat box to the host, and we will respond at the end of the session. We are also recording this session, and it will be soon available on our website for your future reference. Let me now introduce you to our order to cash expert, John Salek. John is the president of Revenues Management Associates, an account receivable and order to cash company. He has about 30 years of experience in the order to cash space. John has worked across multiple industries with over 250 clients. Without any further delay, let me pass on the session to John.
All right. Thank you, Sweta. And excited to be here today. We've got a nice topic, I think a very intriguing and thought-provoking topic here. And without further delay, let's go into it. But before we do, let me just spend a couple minutes to explain to you the genesis of this thinking of strategic AR. And it goes back to two incidents. One, many years ago when I was with International Paper, they had an old paper mill that made just one grade of paper. And it was manila tab stock, which is used in manila folders that you see in filing cabinets. But as some of you may remember, it was also used to give out cards to people who were driving on toll roads, on turnpikes. You'd get one of these manila cards when you entered the turnpike, and you would submit it when you exited, and that would determine the toll that you paid. Well, clearly all of that started to be replaced by technology, and the volumes were going down, and there was no other use for this paper mill. But, you know, they were still selling a pretty good volume. It was still very profitable. So, unfortunately, their major customers, who were distributors, were also seeing decreasing volume, eroding profitability. So, International Paper started just a very small group of people within their credit department who would work with these distributors and give them consulting, you know, for free, and even introduce them to some of their bankers in hopes of encouraging them to grant loans to these companies. And the whole purpose was to keep these customers afloat for another few years, so IP could sell this grade of paper until you know, just for a couple more years. Every year they got was a bonus. So that was kind of a groundbreaking approach. And then just a few years ago, I was in a meeting with a CFO of a large apparel company, a very famous one, and about 85% of their sales would go to the big box retailers, who of course negotiate very low prices, further erode profitability by taking thousands of deductions. And about 15% of their sales went to these specialty shops. Now, sales to the specialty shops were a much higher price, much higher margin, and quite profitable. The only problem was these shops were thinly capitalized and presented a pretty high credit risk. So we're we're talking about deductions, and this CFO said that their automatic small balance write-off for deductions was $25. So that means if a deduction was $25 or less, it was automatically written off. But if it was more than $25, it would go through the whole research and resolution process. You know, for $26, $27 seemed a poor use of resources. So I thought, and I said, well, wouldn't it be better off for your company if your credit team was spending time working with these specialty shops, supporting them, helping them, monitoring the credit much more closely, so you can continue to sell them and actually raise your sales to them, rather than spending time on a $28 deduction. So that's the genesis of strategic AR. I came away from that meeting thinking, well, that's a credit department that is not strategically focused. So what is strategic focus? Well, what we'll talk about today is a quick introduction. We'll define strategic AR. We'll talk about how to transform to strategic AR, review the benefits, wrap up with a conclusion, and then take any questions you might have. So let's just talk about how the management of accounts receivable has changed. And certainly in this economy, for many companies, their revenue's down. Interest rates are at historically low rates. I mean, it's hard to believe. And certainly management focus in the last few years has really shifted towards providing an exceptional customer experience. So all of that requires a shift from what I call traditional AR management. And what is that? Well, it's the focus on transaction processing, collections effectiveness, low bad debt, and do it all with minimum headcount. Which, sounds like reasonable way to run the business, except things have changed. So strategic AR management. Well, the focus is on driving revenue and margin growth, doing those things that a credit department can do to increase revenue and margin. Again, provide an exceptional customer experience. Other than sales and customer service, it's hard to think of a department within the company that has more direct contact with customers than the credit department. And then, of course, managing credit risk to support the firm's trade credit strategy. Still got to produce a strong cash flow. That's not going away. But to do it all, not at just cost efficient, but at ultra efficiency. And we'll explain what all of these are in a little more detail. But suffice to say that the old twin goals of low DSO and low bad debt expense are really no longer the highest priority. Certainly not of the company, certainly not of the finance group. So they shouldn't be the highest priorities of the AR management credit group. So let's take a minute here and define strategic AR and its elements. Well, the first one I mentioned was driving revenue and margin growth. And let me give you some examples of that. It's incumbent upon the credit department to be able to provide the capability to sell profitably to high-risk customers and high-risk markets. The specialty apparel shops that were thinly capitalized, but delivered much higher profit margins. Geographic markets. We can't sell to Africa, anywhere in Africa, because the credit risk is too high. Well, that's quite a sacrifice of potential revenue for a global company. So, find a way. How can we do this? Same thing with new revenue streams or business models. Companies can to introduce new products, new services, sell to new customer segments. How to have the capability to do that. A quick example. Building materials company sold to big distributors who then in turn sold the product to individual contractors. Well, the company came with a new product. It was special acoustic ceiling tiles. And they said, you know what? Let's sell direct to the contractors. Margins and prices will be much higher. And trouble is, those contractors are very thinly capitalized. And you have to deal with mechanics liens and things like that. So, it's easy to throw up your hands and say, oh, none of these contractors are creditworthy. We can't sell to them. Well, you got a new product. It's a new opportunity. You got to find a way to make that happen and sell to those markets. So when we talk about driving revenue, these are the types of things we're talking about. Certainly selling direct to customer segments, certain customers anyway, rather than through retailers and distributors. You get a lot higher price, not higher margin. And then, of course, the ability to profitably accept small orders. If it costs you $100 to process an order, you're probably not going to want to accept orders less than $100 or $150. But using technology and streamlining processes, there is a way to profitably fill small orders. So that's on the revenue side. Margin side, you know, the biggest determinant of margin is price and cost of the product or service. The credit department can't really affect that. But what can they do? Well, let's reduce the margin erosion from self-inflicted deductions. For example, if Walmart says we need the label on your carton to be in the lower left-hand corner, and you put it on the upper right-hand corner, they're going to hit you with a fine of $25, $40, $50 per carton. Well, that'll erase any profit you made on the order. And then invalid deductions. The customer deducts an error and you don't bounce it back and try to collect it. That can add up to, several tenths of a percent of margin erosion. Better control of unauthorized price discounts. Difficult to do that from the credit department, but certainly you can see the evidence of that happening and raise the issue. Matching margins to customer risk. We said in driving revenue section, well, we want to be able to sell to high-risk customers. Good. Absolutely. But you're entitled to a higher price and a higher margin selling to a higher customer risk. And is that being done? And then this last one, kind of an interesting concept too, and want you to think about a little bit. Free up sales team from dealing with AR issues, disputes, other administrative tasks. Let's take a quick example. Let's say your company has 10 sales reps, and on average, they spend 20% of their time on AR issues between the department and the customer and all that sort of thing. Well, if you can cut that to 10%, then you're essentially freeing up one new sales rep. It's like adding one new sales rep. So instead of 2 of the 10 sales reps dealing with AR issues, it's only 1. And that 1 is now freed up to generate more revenue. So there's a lot the credit department and AR management can do to drive revenue and margin growth. Customer experience, we've all heard a lot about that. But as I said earlier, when you think of the people and different departments within your company, who has more customer contact in the credit department? Sales, we hope. Certainly customer service, order entry, those departments. But so much of that is done online, and hope much of it goes correctly without requiring any human intervention, that those departments' level of contact customers could actually be pretty low as well. That's a major part of the credit department duties and obligations. But what are some of the other ways that this customer experience can be enhanced? Well, first of all, accommodate your customers for how they want to pay. There's a lot of new payment methods out there. Can you accommodate all of them? If not, you have to go to your customer. Make sure that you're easy to do business with. It's easy to place an order with you, and it's fulfilled quickly and accurately. And the problem or dispute is resolved, first call, first time right, not 6 emails and 3 phone calls back and forth, So, that's a key part of the customer experience. And then providing this high degree of self-serve capability. Remember, if you're selling to small and medium-sized businesses, a lot of them don't do administrative work during normal business hours. They do it in the evenings or weekends. So accommodate them, empower them. And obviously an uninterrupted flow of products and services. Well, that's great. That may not all possible, but certainly should be striving to do that. And then certainly in this economy, credit risk is heightened. That credit risk needs to be managed, no question. But again, there's a trade-off there between the desire for incremental revenue and the company's risk tolerance. That trade-off, if it's not been reasonably well articulated, push senior management to get them to articulate that and document it. That way everybody's on the same page. What else? The last two elements of strategic AR. Well, produce a strong cash flow. That's not going away. That's part of traditional AR. It's also part of strategic AR. And, the obligation is to generate the cash flow consistent with the financial strength of your customer base. Remember, if the decision is to sell to a lot of financially weak, high-risk customers, well, cash flow is not going to be as robust as it would be if you were going only to bulletproof, right? But whatever, you got to make sure you have the portfolio coverage. Nothing's worse than to say, well, we can only contact half of our past due customers. And as a result, situations get much more serious and controlling that exposure. And then the last one is achieve ultra efficiency. Now, cost reduction has been on the agenda, and a lot of techniques have been used, and a lot of progress has been made. But when you think about the fact that in global markets, a lot of your competitors have their back office and AR operations in low-cost areas, and your ability to raise prices is constrained. So you need to make money, be able to make money at competitive price levels. The need for ultra efficiency has arisen and really gained strength in the last few years. And just to give you an idea, the Hackett world-class performance for the credit to cash ops, meaning credit, collections, cash application, dispute and deduction processing, is 4/100ths of a percent of revenue, not 4% of revenue, not 4/10ths of a percent of revenue, but 4/100ths of a percent of revenue. I mean, that's really low. So when we talk about ultra efficiency, that's the benchmark, which means a lot of companies have achieved it. And really the only way to achieve that is through automation and automating as much as 70 to 80% effort in those credit to cash operations. So if you're addressing these 5 things in as part of strategic AR, then you are managing your accounts receivable strategically. So how do you transform, engineer a transformation to strategic AR? Well, the first one, we talked earlier about automation. First one is a digital transformation using artificial intelligence powered digital assistants. Now that's a mouthful, and we'll give you some examples of that on the next slide. But critical to achieving that ultra efficiency, customer responsiveness and speed. Strategic alignment, policy changes. We'll give you a few examples there. And then of course, process changes, process improvement. But really, it's inescapable that without modern technology and automation, really difficult to get into the upper quartile on any of these activities. So when we talk about digital transformation using artificial intelligence powered digital assistants, here's some examples. Did you know that you can have an online credit app with digital signature and followed up by, once the application is submitted, automatically gathering all the credit information, credit bureau, trade references, bank references, licensing authorities, all the details you need, and automatically score it and actually come up with a recommended credit limit. All what a labor saver that is. And quite honestly, it pushes a fair amount of work on the applicant. If you think of the old days where they'd send a potential customer would send in a credit app and they'd be missing bits of information. You'd have to go back to them and say, please fill out row 7, 12, and 18. Now they can't submit the online credit app unless it's completely filled out. So saves your team time and money. What else is in this digital transformation? Well, electronic invoice presentment and payment, but with a full-featured customer portal. And as we mentioned earlier, you got to be able to accommodate all the new modalities of customer payments. Customers expect it, they want it, and enable customers to manage their accounts off hours and on a self-serve basis. For collections, so much of that can be automated now. The prioritization, the collector workbench, which gives the collector all the tools they need at their disposal to do their job. Automated dunning, so you can contact all your customers. Order hold. And then where the AI digital assistants really come in is on the next two. Disputes and deductions. The digital assistants go to your customer vendor portals or remittance documents and extract the dispute deduction data, start to create deduction, and then based on the reason code, route it to the proper person for resolution. And then similarly on cash application, extract all that remittance data from multiple customer sources, whether it's a vendor portal, a schedule they send you, a document, and they all vary in different formats. And get that information and auto post the cash. And we're seeing some hit rates as high in the 85 to 95% range. So when you talk about cost efficiency, well, an 85 to 95% auto cash hit rate does it. And then the other key thing about the new technology is the advanced analytics capability. Dive down into the root causes, fuels process improvement. As we talk about, a reduction in manual effort of up to 70 and 80%. What else is part of the strategic AR? Well, we talked about the alignment, the trade credit strategy. Basically, what strategy are you going to adopt to optimize your cash flow and profit? Policy changes. We've seen some of these things. We've seen credit managers review 100% of every credit memo application. Well, how about 20%? Another big one is granting an allowance or a price discount for shortages and damages. So instead of getting thousands of deductions for shortages and damages, a customer takes a discount of 0.7%, or some historical base number, and all those deductions are no longer taken. And then the small balance write-off that I mentioned at the outset. We had a client that if they raised that automatic small balance write-off to $600, which was a shocking number for them, that would eliminate the need to research and resolve 42% of total deductions. What a huge volume reduction. And only those 42% of deductions only control 2% of the total deduction value. And then, of course, you're all familiar with process redesign, Lean Six Sigma, all the techniques. Still a role for that. Still a role for that. The benefits, well, my focus today is on the revenue and margin growth, the customer experience, and the cost. But all of these recommendations will also add to greater collection effectiveness and efficiency. And what does that do? customer sat, customer loyalty, higher margins. Ultimately, you'll end up with increased revenue and profit. So, conclusions. Transactional AR management, as time has passed, it's not going to serve you well anymore. Strategic AR management will, particularly in this pandemic economy, and it will elevate you as more of a partner with the C-suite than traditional AR management. Questions? Sweta, did any questions come in from our audience?
Hi, John. This is Paris.
Oh, hi, Paris.
Hi, John. Long time.
Yeah.
So I have a question. So you bring in a very interesting insight into freeing up the time of the salespeople doing the administrative tasks. So now I've moved to MDM and I can now see the whole end to end, and that's a interesting thing. So, and the other insight that you shared was that we should automate more of the credit. So the question really is there are there some good 2 or 3 technologies out there, and if you can guide on how we can partner with those companies who are actually creating these, and that will be something which we can really consider selling to our clients. So that's the question.
Yes, Paris, and thank you. Thank you for the question. Um, you know, again, this webinar is being sponsored by Emagia,
Oh, okay.
and certainly I've spent the past year learning in detail the capabilities of Emagia, and certainly all those capabilities that I mentioned are performed by Emagia. That doesn't mean they're the only AR software company that has those capabilities, but certainly I've seen the Emagia capabilities firsthand.
Mm-hmm. Got it. Got it. No, that's great. So I'm still trying to catch up, and that's why I send you that message that
Sure.
the emails kind of getting stuck in our inboxes because of
Yes.
security policies. So, so,
Yes.
so yeah. Probably what I can do is I can go through more of Imagia, and then I can connect with you later, and we can talk about it.
Great. Thank you, Paris.
Yeah.
Thank you,
Thanks,
Paris.
John. Thanks, John, for your time. And thanks for your insights as always. They're great.
My pleasure.
Thanks so much.
So, John, we do have a couple more questions. Isn't it the sales and pricing functions that drive revenue and profit?
Yes. That's, they're the primary influence or driving of revenue and profit. But if you look at earnings announcements of publicly held companies, and I know that's not something everybody does, but what I've seen frequently over the last couple of years is the CEO and the CFO will talk about programs they have launched to raise the gross margin of their sales. And if they can raise it by 100 basis points or 1%, so if they can raise it from 42 to 43%, they herald that these earnings calls as a great achievement. Again, 1% of a big number is a big number. So it's very possible through the deduction control, the pricing commensurate with credit risk, control of unauthorized price discounts, to be able to raise the overall gross margin by 2, 3, maybe 0.5% of revenue, which is a big increase. So that's, yes, sales and the pricing team have the major influence, but don't underestimate the contribution that the credit management team can make as well.
Great. We do have one last question, John.
Sure.
And its cost efficiency has been an objective for years for most companies. Why is it included as part of strategic AR?
Well, as I mentioned a little bit earlier, the pressure has intensified with global competition, restricted ability to raise prices, global competitors having their operations in low-cost areas. It's intensified the pressure on cost and efficiency. So, companies are looking at every facet of their operations and ask the question, are we competitive? Are we world-class? Are we close to world-class? Are we upper quartile, upper half? Where are we? And we certainly can't be in the lower quartile. And if you're in a business where you sell to large numbers of thinly capitalized customers, or you incur hundreds of thousands of deductions in a year, your credit to cash team can be quite large and quite expensive. So that puts a premium on ultra efficiency.
Sure. Makes sense. Thank you, John. I think that's the end of our questions here for today. We have now come to an end of our masterclass. If you all have any additional questions, please do email at us info@emagia.com. Thank you everyone for joining us. And just a quick heads up, our next masterclass is on Jan 28th, and the topic is boosting revenue with AI-powered digital credit. Please do book your seats today. Have a great rest of the week.
Thank you. Thank you, everyone.
Thanks, John. Thanks. Bye.
See you next time.
Cheers. Bye.
So long.